Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. This is The Talking Point. It's Monday morning, July 25th. And hello from Focus. It has been a busy Sunday, and it's going to be an even busier month today and tomorrow. But the market is one of the busiest that we have seen, and it is an important week, extremely important week. So let me get started. First of all, it is a big week for earnings. So far, 21% of the S&P 500 has reported, and 70% have already beat expectations. You know, this is a very odd earnings season, needless to say. The pessimism coming into this earnings season has been dramatic. Again, this is the second quarter earnings. This is looking behind. But nonetheless, you know, everyone in the pessimistic camp said, you know, this is the quarter. We'll start hearing all of the problems because of the downturn in the economy. Input costs high, input costs being, you know, wages that companies have to pay and the materials that they have to pay and so on. And yet companies have been persevering. And basically, again, I just want to say that the bad news from the companies, and this is what's interesting, the companies that came out with some bad news, the market was prepared to forgive these companies as long as the bad news was less than what the market had expected. And that's an interesting discounting of bad news. So again, to just go over it, if the company had come into the earnings report and the consensus estimates from analysts was bad news, but if the company beat on that bad news, in other words, the bad news was still not great, but not as bad as the estimates had been, the market was in essence saying, okay, especially, by the way, if the companies had a little bit more positive guidance, looking ahead. So the question is, has all of the bad news already been discounted by the market? When we use the term discounted by the market, we mean kind of taken in. We already know what the bad news is. It's going to be interesting. This week, 170 companies from the S&P 500 will be reporting. But all eyes will be on big tech. Yes, this is big tech's week. We're going to hear from Apple, Amazon. We're going to hear from Meta, Facebook, and also Alphabet, that is Google, and also from Microsoft. So it is going to be an extremely important week for the market. Remember, big tech actually is a big chunk of the S&P 500. When we put them all together, they're about 20% of the S&P 500. So this is an important week in terms of earnings, extremely important. And remember, too, guidance. We want to hear what the companies are saying. Now, all of the big tech are big sellers overseas. In other words, their markets are larger than just the U.S. market. So what happens with the stronger dollar? Remember, the stronger dollar is great when we're going over to Europe to visit or London to visit. But let's put this in here. If you are selling overseas and you're not hedged, what is going to happen is you're going to hear them talking about the stronger dollar, how it's hurting their revenue, how it's hurting their bottom line. Overall, about 2 to 3% of a hit comes from the stronger dollar. So it's especially important when there are concerns about earnings. There are concerns about global growth and whether or not there will be consumer demand for the products. We're going to find out a lot about this week. So stay tuned on that score. Also, I do want to report some good news. First of all, port activity. You know, that is to say the containers that have all of the equipment that I need to settle into my kitchen. Port activity has actually started to show signs of some stabilization, and that is very good news for the supply chain. Also, in terms of trucking freight prices, they've come down, but they remain solid, actually. There are still concerns over shortage of labor and labor cost, but overall, the trucking sector, so to speak, stays in solid territory. And also, that is very good news because it's also a picture of the economy. You know, if you go into a deep recession, trucking activity typically slows quite a bit. So this, I look in the good news category. It's telling us that things are okay. And in terms of that port activity, I think that's extremely good news because port activity has been slowed dramatically. And it looks like it may be just now starting to pick up. One other thing, we talk about seasonality in markets. I don't know if we can use that now in the situation we're in as the Fed continues to fight inflation, as there are still issues with the supply chain, although that too is moderating. That said, technically, historically, August and September tend to be difficult months for the market. We'll see if it holds, this calendar season, because again, anything that could suggest that the Fed may just soften its rhetoric in terms of fighting inflation, become a little bit less hawkish, it will be good news for the market, despite the fact that August and September historically tend to be dicey months for the market. Also, one last thing here before I get into the what we expect to see in terms of data releases, and we have some extremely important ones this week, and that is the rally we saw last Tuesday. It was a really good rally. We saw the S&P 500 move up. We saw the NASDAQ move up, but it did not endure. What we look for in rallies is continuation. We look to see, are we seeing the rally continue over a course of days? And obviously you saw the end of the week was actually pretty much in the red when we closed. But there was something else extremely important, and I want to use today just to mention what it is. Typically, when we see the end of a bear market, we don't get a letter. You don't get a sign. Oh, this is the end of the bear market. No. We look for signals in the market itself. And one of those signals is this. When the rally comes, just as we saw on Tuesday, we were looking to see how many names in the S&P 500 had been able to cross their 50-day moving average. And this is important, and you could call me or just look up what the 50-day moving average is. That is a technical of how the individual stocks, individual companies move. So we look for that because what we want to see is in a strong rally that 90% at least of the S&P 500 cross their 50-day moving average. And the number, alas, was only 58% of them crossed their 50-day moving average. In previous turns in the market, I will go back to August of 1982, when finally, we saw a change in the market. The trend changed in August of 1982. We saw that happen. We saw that 90% and more of the S&P 500 crossed its 50-day moving averages. Important because, by the way, August of 1982 was the beginning of a major secular bull market. Keep in mind that Paul Volcker, head of the Federal Reserve, had been raising rates to heights in order to get rid of inflation. It put the country into a recession. And yet, August of 1982, in fact, we learned that he was going to start lowering rates. And the market saw it. And we saw a major move in the market. Also, in 2009, remember 2008 to 2009, we had a horrible downturn, and yet the Fed was trying all kinds of things. We saw that rally hit in 2009, and that same thing, over 90% of the S&P 500 crossing crossing its 50-day moving average, taking us into the recovery. And this very important. I'm going to give you one last one because you may remember it. You may remember how awful 2018 was for the market. Chairman Powell trying to normalize rates, not fighting inflation, but normalizing rates. Came December of 2018, and at the Fed meeting, they raised rates and they telegraphed that there would be 2 rate hikes in 2019. The market in December of 2018 just turned down so dramatically, it was fierce. And then on January 4th, 2019, it was a Friday, not a Fed meeting. It was the first labor report that we had for 2019. Before the market opened, Chairman Powell made this comment. The Fed is going to remain patient. And the market had not yet opened, folks, but the market, the futures rallied like crazy. And the market that Friday, we saw that S&P 500 move and move and move, but we watched to see the number, the percent of the companies of the S&P 500 crossing the 50-day moving average. It was fierce. And then we saw the rally continue the next week. We saw continuation of it, which is what we look for. We look for about 10 days, by the way, the average of 10 days, to see whether or not it's coming. We call this velocity, the surge in the market, the velocity in the market. It takes off. So that didn't happen with Tuesday's rally. We were happy to see it. And we were also happy to see consumer discretionary taking a little bit from consumer staples. We were happy to see some of the actual, growth parts of the market do well. Semiconductors, for example, doing well. But nonetheless, we always say we look to see if they are doing well in an uptrend or a downtrend. Alas, right now, consumer discretionary still in a downtrend. Same thing with semiconductors. So we're going to pay attention this week to the earnings coming out from big tech. We have a Fed meeting this week. Oh, yes, we do. And on the 7th, we will get their announcement. We expect to see it 75 basis points. Obviously, the market is going to be listening to the press conference, where they're going to be watching the statement to see if there's any hint whatsoever that the Fed will go easier at the next Fed meetings. It's going to be very important. And not to mention the commentary from Chairman Powell. Does he see the Fed beating inflation? And this is going to be all important for the market because that would suggest that the Fed is not going to have to be as hawkish. So we'll watch that. Also this week, in terms of data, let me go over it quickly because I have a 15-minute clock and it is getting close. Tomorrow on Tuesday, we're going to have the home price index. And, home prices have actually held. We're going to see if it's starting to fall yet again. Overall, it's held, not all the parts of the country, but we're going to see if the home price index year over year, by the way, whether or not we see it easing in a material way. And we will also have consumer confidence. We'll have new home sales. And then on Wednesday, we're going to have the durable goods orders. This will be for the month of June. And what I'm looking for is what we call core capital equipment orders. This is what companies are doing, and what we want to see are companies still spending. That will be a good sign that companies feel confident to allocate money towards equipment. Then we're going to have the pending home sales, and then on Wednesday we'll also have the chairman's press conference, Chairman Jerome Powell of the Federal Reserve. But here's one that is really important for the market. And this is going to be GDP. The GDP, gross domestic product, for the second quarter. Here's where it gets interesting. The first quarter, as we know, was down 1.6%. There is a debate right now whether or not the second quarter, that is the quarter we just finished, whether it will be in positive territory. The estimates are that we could actually squeak out a positive read. Consensus estimate has it as 0.3%. Not great, but not negative. There are also concerns because the Atlanta Fed Now survey, which is what a lot of people watch, it moves on a daily basis, has it down about 1.6%, meaning a negative. We're going to see what we get, right? We're going to see. I've also seen some estimates coming in at a positive 1.5%. This is the widest range of estimates that I have seen in a long time. Why does it matter? It matters because if we get 2 quarters of negative growth, so if this one is negative, there are going to be folks who say, aha, we're in a recession. We're in a recession. 2 quarters of negative growth means a recession, but not so fast because the National Bureau of Economic Research, the arbiters of when we go into recession, look for a lot more. They look for a really slowing labor market that's going in a big downturn. They look for retail sales collapsing. They look for personal consumption coming down. They look for a lot more, and not just 1 month of it. They want to see 2 months of it at least before they declare that a recession began. So that's what we're going to have. And then Friday, also extremely important, we're going to have the Fed's very favorite inflation reading, and that is the PCE inflation index, the personal consumption estimate inflation expenditures index, the PCE. And we're going to see where that is. That for the Fed tells them the story of how inflation is, where it's heading. And obviously, we're all watching inflation. We'll also have real disposable income. Obviously, that's important because we are seeing a bit of a slowing in the accounts that Americans have. Overall, when we came into the sort of the post-COVID era, we had about $2 trillion, showing that Americans in banks and bank accounts still had a cushion. That is easing a bit. It's not collapsing, but it is easing. Money supply actually is starting to ease. In other words, M2, that's money supply, coming down a bit in the banks. And we will also have something else that everyone is watching. This is the Employment Cost Index, the ECI. Why is it important? Because it gives us a big picture of whether wages are heading up and how fast are they heading up. It's something, by the way, that the Fed pays attention to because, needless to say, they want wages pulling back because wages are a major input cost for companies. And if wages keep going up, companies are forced to raise their prices and hope that consumers, businesses take the higher prices. And this is one where the wages that we saw from the labor report, the last one, hourly wages stayed level, and that's good news. They, for 3 months, staying the same, not going up, but not coming down either. And then we'll have the final of the University of Michigan Consumer Sentiment Report. And we know why this is important. It's important. We know consumers are not happy, but what we want to see is how do they see inflation over a 5-year period. It came down in the last read to 2.8%, and that was a major relief. What we don't want to see is that consumers are saying they see inflation rising higher over 5 years. That means it's becoming entrenched, and that means the Fed's job is harder. So, folks, a very difficult week for the market, digesting everything in terms of earnings, in terms of guidance, in terms of what the Fed says, and extremely important data releases. I can't think of a busier week for the market, but overall, the market is showing signs that, it wants to look ahead, it wants to see the future, and it wants to see a brighter future. And so have a good week. If you're at Focus, I hope I see you at our research booth. We're giving away T-shirts, and they are as cool as can be. Really, really great looking T-shirts. So please come by and see us and say hello. Have a good week. Don't hesitate to call. I'm still answering calls and answering emails. Thank you all so very much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.